Understanding inflation and what effects it has is a question that I'm actually asked an enormous amount. What effects does it have and why is it so important to every individual and of course every single company? Well, let me explain the causes, let me explain where we're at right now and what you can do so I can give you the information that you need either as a business person or as an individual in order to make the decisions that you need to make about your financial future. And I promise you, it's absolutely vital information that nobody should miss. So let me explain first of all what causes inflation in the first place. Let's apply the current situation in the world. Well, if you think about inflation, it's actually a supply issue. So think everything ultimately when it comes to price depends on supply and demand. If there's not enough supply and there's excess demand, guess what? Prices go up. Why is it such an issue? Well, the reason it's such an issue is if it becomes embedded, in other words, it becomes an attitude where people expect it to continue to happen. Then what happens is that people stop saving money, they try and buy things quicker, everybody wants a wage rise, and then you get also with that social unrest. So what supply issues do we have? Well, of course, we had the supply chain issue. And what happened when COVID stopped, the lockdown stopped happening, was there was a breakdown. All of a sudden there was excess demand and people couldn't cope. There wasn't enough supply. In fact, in some particular industries, let's take the coal industry as an example, but many where that actually closed down coal mines. And all of a sudden there's this massive demand for energy. To suddenly turn it back on, the switch back on was difficult. We look at planes, we look at aircraft companies and airlines. Again, the same thing. If you've looked on reduced massive amounts and then suddenly there's a demand, guess what? Okay, you can increase your prices. In fact, you have to, and it takes you time to solve the issue. You've also got a supply issue with manpower. So after COVID, particularly in America and the US, people over 55, there was a large proportion didn't go back to work. Okay, why? Well, in those particular countries, more people invest. So always, if you invest, you have the luxury at some point in your life of having a choice. Do you actually want to work? And of course, many people in both of those countries chose not to. So we had then, particularly in the UK with Brexit, a lack of supply of workers. Of course, it's affected everybody. And in fact, it's affected Europe as well to some level, but not to the same extreme as it has in the UK and the US. Right now, we're seeing inflation higher in the UK than other places. And this is one of the reasons. We're looking around 10%. In America, we're looking around 7 and 6% in Europe. What's the good news? What's the bad news? Well, first of all, the good news is something can be done about it. However, the bad news is it's a blunt instrument. What do I mean? Well, the only way that governments can really do anything about it, unless they ease immigration, is actually to raise interest rates. Why is it blunt? Well, in order to keep raising interest rates, you're squeezing the economy. So think, if you over squeeze it, you crush the economy. So governments and central banks, they have to squeeze it enough, cause some unfortunate unemployment in order to ease the situation. The economies are growing too fast. And of course, again, that causes issues. So if they push too hard, that causes an issue. Okay, what we're seeing right now, well, particularly with the UK, they're in a tougher situation because the economy is not growing as rapidly as America. America also is more adaptable. Why? Because they don't have so many rules about changing and adapting as perhaps they do in the UK and even worse in Europe. What do I mean? Well, if you want to lay people off, in America, it's much easier. Companies can switch quickly. In Europe, more difficult. UK is more difficult than America. So America can quickly lay off, quickly adapt. So when we get a downturn, then America tends to, historically at least, adapt quicker. What we're seeing right now, well, we're seeing that jobs continue to grow, particularly in America. So that worries people. Why? Worries investors. They're saying, okay, if this continues to happen, interest rates are gonna go higher. What effect does that have? Well, of course, companies then that have borrowed money, then it costs more. Individuals, if they've got loans, and most people have got either a mortgage or a credit card, then again, interest rates go up, they get squeezed, they spend less money. Okay, so what do you do? What's your advice? Okay, well, ultimately, you should talk to a financial advisor because really it's individual situations. But let me give you an overview. First of all, mortgages. Perhaps you've got a choice on a mortgage. Should you fix or should you go variable? For me, you see the following. You see commodity prices already falling. Like it's not totally in the inflation that we're seeing, that's historical data, it's to come. Okay, so we're seeing that is gonna come down. We're seeing companies lay people off. It's not happening as quick as they'd like, but you're gonna get a downturn, or if you like, unemployment, which in effect means people spend less, and actually inflation is gonna come down. It'll come down quicker in some countries than others. So for example, it's likely that the UK would struggle more. Why? Okay, well, because of Brexit, yes, okay, there's a lack of people to work, so therefore you've got a situation where they'd have to keep interest rates higher longer. So let's go UK. Would you fix? Okay, would you go variable? It's an opinion, it's a tight one. For me, I'd go variable. Why would I go variable? If you fix, okay, I actually think interest rates by the end of the year will have peaked, and then they're gonna come down, I think, quite quickly. It's an opinion, talk to an advisor. Ultimately, nobody knows the future, no one's got a crystal ball, but for me, you're gonna get peak, economy start to drop, inflation dropping quicker than expected by the end of the year, variable for me. Okay, you're an investor, what are you gonna do? Okay, well, first of all, if you are investing money right now, I would invest in non-discretionary spending. Okay, in other words, I'd look at companies where people spend money regardless. Why is that good advice? Nice and simple. Those companies are going to keep going regardless of whether there is less spending. Okay, and I would almost guarantee you there's going to be less spending. You've got mortgages have gone up, credit bills have gone up. In order to get rid of inflation, there has to be more unemployment. So it's almost guaranteed that that means that you're going to get less spending. Does it necessarily affect the stock market? Well, the stock market looks further ahead. So you can actually say, well, not necessarily, because the pricing can already be in the market. However, if I'm an investor, I'm going to be diversified, and I'm mainly going to be in non-discretionary spending. Personal opinion, take advice, because it does depend on an individual situation, and you might be willing to take more risk than others. Should you go fixed rate? Well, now we've got the opposite of a mortgage. What do I mean? Well, with a mortgage, you might want to go variable because I think interest rates are going to go down. But if you're an investor, you might want to fix it for a period of time. Why would you fix it for a period of time? Well, if I'm right, and of course, it's based on my experience, but lots of things can change in the world. Everybody's got to realize that. But based on my experience, then there's a reason for at least having a percentage of your money in some fixed rate for a period of time if you don't need the money. Why? If I'm right, interest rates come down in 12 months' time, then what that means is if you fixed it for 2 years, 3 years, plus, if you don't need the money, then you're likely to begin a higher return than you would in a year's time. Again, it's an opinion. Okay, next, credit cards, anything like that, high interest rates, always the same advice. Okay, nobody's going to argue with me. You should always get rid of that high debt cost as quickly as you can. Always talk to a financial advisor. Please like and share the video. It just gives you a feeling for the current market. And I promise you, doing nothing is not the right answer. Everybody needs to just think it through. Where's their current situation? Do a little bit of planning, even if it's just 5 minutes of thinking through. What's your credit cards? What's your mortgage? What's your plans? If you're a company, it's longer than 5 minutes. Talk to a financial advisor. Why? It's like having a mentor. It's like having a coach. Somebody else giving you an opinion. You still make your own mind up. ultimately. As I said, please like, please share the video. Okay, and give us a follow or subscribe, because I give you information that allows you to make good choices yourself. Thanks for watching.